Hey everybody, welcome to Trading Capital's daily analysis video here on June 2nd, jumping right into the natural gas chart. First off, before we analyze a couple of the sectors and indices, I want to apologize that I've been under the weather the last couple of days, hence the reason why there have not been video wrap-ups for the last 2 days. I still am a bit under the weather, but I'm feeling much better to start producing more content, so I just want to apologize. That being said, I've still been able to execute and issue trade alerts over the last couple days as I've continued to watch the markets. I just want to say congratulations for taking profits on Apple the other day. We banked 7.7. We also closed our Amazon trade for a beautiful gain of just under 7% as well. And then we also sold Spotify yesterday for a huge, magnificent gain of 18.47%. So wonderful job on closing those long positions. And the common theme is as we close our long positions, I'm still expecting that the markets will have some sort of a turn, a next downturn. Now, there could potentially be more upside in the markets, but I am expecting that inevitable next leg down to start sooner rather than later once we head into major resistance points here on the chart. But we'll touch base on the S&P 500 and other indices after natural gas here. So looking at the natural gas chart, beautiful price action. This is exactly what we want to see. This price action comes on the latest EIA inventory numbers. Nat gas and crude inventories were released today. Essentially 90 billion cubic feet build, which came in line with expectations. And this is why we've seen this massive reversal on natural gas. You were positive on the day, up over 2 to 3%, and then you completely reversed. And the kicker that I'm noticing is this is the theme. We've had this massive volume candle. Look at the size of this volume candle, and we still have an hour left on the natural gas trading session. And it just shows you that the buying pressure is decreasing as the sell volume is increasing. So it stands to suggest there's a way higher probability of natural gas seeing continued further downside. And we are certainly positioned for more downside. Notice how you had this massive reversal candle here on heavy volume. You had another heavy volume day here, reversal candle at the high, and now you've taken out on a volume basis the highest volume candle that you basically saw for several weeks and months. And you have to go all the way back to 2021 to see a greater volume day, which was right over here. And look at that volume. That significant volume bar signified a near top in natural gas, which inevitably sent natural gas collapsing basically 45%. And yes, this price action here was before the war, but it still shows you the power of volume and candle formation and a profit. So analyzing volume candles is so crucial because it will inevitably give you that extra edge that enables us traders to find the highest probability trades and be positioned to execute a profitable trade. So with natural gas reversing and now basically closing down on the day, just around 3 to 4% down in the day, you can notice that we're trading at this channel. We've been stuck in this channel for quite some time, and essentially you've hammered on this channel once, you popped off of it, and now you're reversing and hammering on that channel again. The more times you hammer on the support line, the weaker it's going to get. One of the reasons why I believe we've seen this reversal in natural gas and I expect more downside is for the one simple fact that the EIA has now said our natural gas reserves are at around 1,902 billion cubic feet, and total working gas is now within the 5-year historical range. So that is the EIA's own words saying that we are now within the 5-year historical range. So with us now being in the 5-year historical range instead of under the 5-year historical range, it certainly gives more strength to the bearish case. And I'm certainly in the camp that we see a lower natural gas price in the coming days. So the next area of support will obviously be this major green bar low here. Once we break through that, and since you're kind of consolidating above it, I do think you ultimately go test the 50, and then this major 650 area will be your major support. Whether or not we get through the 650 area, it will ultimately dictate on how the remaining building season goes. I still think there is a chance that we can break through that 650 area. But again, you have to respect that natural gas certainly has bullish sentiment underneath it. And with the backdrop of the war, we just don't know where that average true price is going to really come in. Now, if there's some sort of diplomacy that occurs in Russia, Ukraine, then natural gas will certainly slice through the 650 area and go much lower. So we'll just have to keep monitoring the price action, but I do anticipate a move down to the 650 area sooner rather than later. If we take a look at the oil chart, oil inventories also came out today. There was pretty much a drawdown across the board. Initially, oil saw a major dump out and then it got bought back up. And one of the reasons it saw initial dump out is because OPEC Plus came on and said they were going to up their production and basically start releasing more oil. And at first the markets took that as bearish news for oil. However, clearly based on the price action, you have seen that people were kind of expecting OPEC to come online with more supply, maybe in the range of 1 million barrels or 900,000 or 800,000 barrels instead of, I think, around the 600,000 or 640 level that they're willing to bring online. So clearly it shows that whatever they are coming online with in excess is still not enough for the markets. We're still in the camp that oil will see demand destruction with the economy slowing down. We still have rate hikes. Canada introduced a new rate hike today. We also had Canadian GDP fall. It declined in quarter four in 2021 from 6.4% down to 3.2%, so nearly a 50% reduction in GDP. Despite it not going negative and contracting, it's still a significant drop in economic output. So that's just a little factor here in Canada that we have to witness. And then we all know the US GDP is forecasted to decline again. And I certainly think once the real estate market starts to falter, then you'll start seeing that GDP decline even more. Let's take a look at the S&P 500. The spiders have had a strong day today, up over 1.77%. You can see you're breaking out of these little pivot zones here, but you're still into this wide range red bar of resistance. And you can notice that just based off of the volume on this specific candle over here. This volume bar is essentially your biggest volume bar all the way up until this reversal here. And notice how these two candles are almost exactly at the same level. So you're going to have tons of resistance climbing through this candle over here. I think that's your next big level, and I will potentially be looking to short the S&P 500 at these levels. And I've certainly not been shy to accumulate short positions as we've been unloading our longs. We're shorting PSTG, we're shorting Archer, we're also shorting Unilever, which we're in the money on. So there's shorts that we are currently accumulating and expecting the next downturn in the markets. And I do think that downturn will come. Inevitably, the markets do bounce and float up a little bit higher than most people anticipate, but that's the nature of it. It tends to suck in people that think the bear market is over. In reality, I don't think we're nearly close to finishing this bear market due to the fact that inflation is still high, the Fed is still tapering, the Fed is starting quantitative tightening, and with contracting GDP, high energy prices, there's just too many catalysts, in my opinion, to not push us over into a recession. So first resistance, your next resistance point is up here. One of the reasons that I'm concerned about this spider float up, the volume has been extremely light, especially today. We're currently trading 62.5 million shares, so that's even lighter than the previous day. You can notice down here, the buy volume is declining, so all these green bars are slowly declining and making lower lows. So that's something to notice. As the buy volume dries up, expect the sellers to start taking control over the price action. And we may get up to this resistance point up here, but there's going to be tons and tons of resistance at that point in time. If we take a look at the QQQ, the QQQ has also had a strong day. So tech has basically been dominating this rally. It had a little bit of a hiccup this morning on the back of Microsoft releasing and revising down their forward guidance, expecting higher costs, less profit, etc., etc. So you can see for the QQQ, your first resistance point is coming in at this low range green bar here. If you get through that, then you'll have a secondary resistance point up here, and we'll just have to wait and see how the Nasdaq progresses. Let's take a look at Amazon for a quick second here. So we unloaded Amazon because you have had 1, 2, 3, 4. You had a little bit of a doji, and now you've had this 5 out of 6 green candles in a row. You've had a significant move off the low, going from all the way from 2,000 or to just over 2,000 to now 2,500. So I decided I wanted to start peeling back some of those long positions, especially since the forward guidance of companies have been really weak. Microsoft did get bought up really quickly, so that is interesting to see. If we take a look at gold, let's take a look at gold. Gold has had a terrific day. If we look at gold here, gold's holding its gains. Usually what we see in gold is a rally in the morning and then a sell-off in the afternoon, and gold has not done that. Gold has held its gains completely. It's very impressive, now challenging this 1869 mark, which is a former resistance level. So if we break through that, that is pretty optimistic for gold. We are long the GLD and the SLV, so it's good to see that those metals positions are playing out. I still think there's a potential that gold can go lower, but we'll just have to keep monitoring that. One of the reasons why gold is performing is if you take a look at the US dollar here, the DXY. DXY had that initial pop which put some pressure on gold, and it's had a massive reversal, and I do think you're putting in this little bit of a bearish consolidation here to eventually break lower to this 99.40 area. I think that's where we're going on the US dollar, which will inevitably help propel gold to the upside. Typically, gold and the dollar have I believe a 97% correlation rate. So when a rising dollar occurs, gold typically falls. And when gold rises, typically the dollar is falling. So it does have that inverse relationship. If we take a look at the US 10-year yield, let's just take a look at that. So, oh, this is the wrong one. I apologize. US 10-year government bond. So the US 10-year, you notice how we have this parallel channel trading over here, which you hit as resistance up here, pulled back to the center point of the channel, came up, hit it again as resistance, and now you've floundered sideways, broke the key level of this parallel support line, and now you've come up to retrace it. So I still think there's more downside in yields, and notice how there is this little bit of a head and shoulders pattern playing out. So here you have this left shoulder, you obviously have your head, and then I was originally thinking that this was your right shoulder, but it wasn't really a very symmetrical right shoulder. But it now seems that if you come up here, then you'll have a better shoulder that you can use as a right shoulder to play against. And obviously you'll have your neckline down here. If you break and trigger the neckline, it sends you down to this maximum downside move of 2.37%. But I do think rates will move higher after they keep consolidating at a lower range. We should see yields start to push up a little bit higher as the Federal Reserve raises the Fed fund rate. Let's take a look at Archer. Archer's another position of ours that we are shorting. Archer Aviation essentially is one of the most speculative companies that you can invest in. It's flying vehicles. Yes, there's a potential catalyst that they could be bought out, but I still think that a merger or a buyout of this company is not likely to happen just due to the fact that we are in a tightening cycle and there's less liquidity in the system. We are slightly out of the money on Archer. It did have a massive move today on the back of a strong market, 13.58%. We did add to our short position at 5. It's brought our average to the 439 level. Archer has had 5 days in a row of upside. In 5 days, Archer has moved up at the highs 53%. That is an astonishing bounce in Archer, and I do think you are now approaching this upper resistance parallel channel. Once you hit the top of this channel, it does favor a pull-off back to the low range of this channel. So will I hold this short all the way down to this low range of the channel around 263? Probably not. I'll be looking to most likely take profits on this bottom of this wedge pattern, which would significantly be a beautiful, beautiful trade for us once that occurs. And I do think Archer Aviation will fall very, very hard, especially much harder once the down leg in the markets come. Right now, again, the markets have floated up on light volume, so all of these speculative investments tend to move a lot higher on lighter volume when the markets catch that bid, and that's certainly what we have seen with Archer Aviation. So we'll just have to keep monitoring that short. We do have another 1 to 2 add levels on Archer in the event it goes higher. If it does push to the top of this channel around this double top zone, I will look to add to our short, and if it moves higher than that, we'll start to look at additional levels at that point in time. If we flip to let me just take a look to see if there's anything else I want to talk about. We'll talk about Unilever, because that's a new position of ours. So UL, one of the reasons why we shorted UL here at this let's see, $48 level. So let me just move my green line up here a tad bit so it's on our exact short level. There we go. So $48 is where I issued the trade alert. One of the reasons why I issued that alert is you were approaching this gap fill. You're also approaching this longer term resistance trend line. And Archer had this initial pop-up, or sorry, Unilever had this initial pop-up off of some good news, the dividend release expectations as well. But in all reality, when we see these stocks gap up, these gaps get filled, 1 to 2 weeks later. They do not hold these gap up gains. It's usually a gap and crack. That's the environment that we're in, where the gaps do not hold, and these gaps act like magnets to typically pull the price action back down in. Now there is a gap, since you closed at the high here at 48.32 and gap down, there is a chance that you can go back up to test this area, but again, you'll run into this downsloping resistance trend line, and we are significantly in the money now. I do think it's very likely that we go to fill this gap down here around this just under $44 level. So that's where I will be looking to close this trade, and that would be a wonderful, wonderful gain for us, just around 8.29%. And that could happen in the matter of a few days. So be on alert, be ready. For those of you that took Unilever with us, it is looking very, very promising at that point in time. Let's take a look at PTSG and why we shorted that today. So, PSTG, my apologies. I'm transposing the symbols there. So PSTG has had a massive pop on earnings. You can see here they reported strong earnings. And the trend in this environment is just like Tesla had a double beat on earnings. Apple had strong earnings. All of these companies are reporting strong earnings, but they're still not holding their gains. And we shorted here at the 28.90 level because you're into this wide range bar of resistance. And if you flip to the intraday basis, one of the reasons I pulled this trigger on this short is for one simple fact. Let me just get my bearings here. You had this massive, massive move up, and you are on a little bit of a time count here. You had 1, 2, 3, 4, 5, 6 green candles in a row. I decided to pull the short here at the 28.90 level, and we haven't looked back since. We are slightly in the money, but again, I do think for this particular stock, you will eventually go back down here to fill this gap fill. So with the move today, PSTG was up over 22, 23% at the highs, and now it closed around 18.2% up on the day. So I do think this stock will come in hard once the down leg starts in the markets. And just keep in mind, the markets have had a substantial rally off of the lows, and we have had that little bit of reprieve after 7 down weeks in the NASDAQ, and I think 6 weeks in the S&P 500. Or 6 consecutive down weeks in the S&P 500. So the markets are favored to still keep that positive bounce going, but the volume, and I stress about the volume because it's one of the biggest indicators that have saved my life. Just being able to understand and read volume is key and essential to putting yourself on the right side of the market. So PTSG, we're in the money, 28.90. We have plenty of room to add to this position in the event it does go lower. On a long-term basis, you can see here that you've been chopping in this parallel channel since the COVID low here. then you made a high, then you came back down to test the low range of this channel, then you popped all the way back up, and then you came back down to the low. I don't think we're going to go test the top range of this channel. You may come up here to fill this gap around the $30 level, but I do think you're going to run into tons of resistance at that point, and I do think PSTG will come down and test the low range of this channel and fill a couple key gaps at the low range here. In the event it does go higher, we'll add to our position around here at the $30.08 level. If it gets through that level, the next resistance level that we'll look to add at is over here. And then if it gets through that level, this key technical gap will eventually be another level that will start to accumulate a larger short position on. That's it for today. I hope all this analysis helps, and thank you again for being members, and congratulations on all the profits that we have banked over the last couple days. Hopefully all of you are continuing to trade wisely and not over leverage yourselves in any one specific position, because these markets can and will turn on a dime again. It's very, very, the markets seem like we're kind of in the calm before the storm scenario. And one of the things, if we flip back to the S&P 500, I just want to discuss one of the things. According to the previous 2008 collapse and the previous 2000 collapse, so the GFC and then the dot-com bubble, the NASDAQ and the S&P 500, they made roughly 1, 2, 3 lower highs before rolling over and having a significant crash on the 4th. So if the cycle is to align to the previous 2 collapses in the stock market, then this would suggest that this is the last bounce in the markets before we have a significant crash in the markets. Now, no one can foresee. I'm just going based off of previous cycles, since the 4th pivot, since the 4th lower low signified the crash in the markets, and we're certainly approaching that area on the indices. And the crashes don't happen at the highs, they don't happen at the lows, they generally happen around the midpoint of the pattern. So we're certainly around that middle section, and I do think that there's a lot of people that are starting to turn more bullish again with this bounce occurring, and it has been an extraordinary bounce. That's why we swing trade and go along both directions, because inevitably you do get bounces, but you have to sell into strength and accumulate oversold, overbought names at key technical levels to position yourself at the right levels. So thank you all, and I hope you enjoy